Good morning, everyone. This is Curtis Hawks with Insurance Agency Marketing Services, and I want to thank everybody for taking the time to be on the call with us today. Today, we're going to be going through the second of our two-part series over life insurance with Mr. Jon Salomon. He's the founder and CEO of Optima Financial Services, and last week we had a really good attendance. Jon did a really good job of giving us a good overview of the different types of products that are out there and some points to consider both when reviewing and analyzing a portfolio as well as from a presentation standpoint. And today is going to be going in and doing a really deep dive on the indexed UL space. I think a lot of advisors are aware of indexed universal life and they've seen an illustration, presented it, sold it, but I think one thing that a lot of people aren't aware of is there's a number of different intricacies that can impact how an IUL accumulates as well as the income distribution standpoint. He's also going to be spending a little bit of time chatting about what we think the future holds in the IUL space. And one of the things that I want to mention as well is IAMS is committed to our advisors. One of those commitments is making sure that we're going out and finding some of the best experts out in the field, in the industry, that we can bring on calls like today, to where they can help educate, and there's a significant amount of information that you can get and learn with them. Before we get into the presentation, though, I did want to take a couple of minutes to talk a little bit about some of the additional ways that IAMS can partner with our advisors. One of those is with our new producer builders, and this program is really designed around helping advisors that are new to IAMS. And if you're getting started with us or you're interested in working with us, this is a great way for you to get in, get some production, see what we're all about, and help us partner with you in your business. And you'll see we've got a smattering of different things on there. And the reason for that is every advisor is different. They're in different areas of the country, they're at different stages of their career. And so this is a good way for us to help meet you where you're at and help you to get to where you want to be. And I would also point out too, if you're currently doing some things that are working really, really well for you, then give us a call and talk to us about it, because we're more than happy to look at how we can customize this just to your business. In addition to that, we've got a couple of different things with our IAMS Business Builders. One is our referred producer program. You will get a $50 bonus when you send somebody our way and they get contracted. And then, and really this is some of the biggest checks that we cut. On an ongoing basis, you'll earn revenue off of their production. You don't have to do anything. We'll take care of the agent. We'll provide a high level of service for them, but you'll get checks on a quarterly basis based off of their production. In addition to that, we've got our marketing reimbursement program. And again, this is a great way for IAMS to put dollars into your marketing budget and really double the size of your marketing budget. So as you're producing business with us, whether it's on the annuity or the life insurance side, it's a great opportunity to get additional advertising dollars to expand out how you're marketing to individuals. In addition to that, we've got our creative services department. And what I can tell you is that a core theme that you'll find with that division is customization of what they do. So there's a variety of different things that they can do, whether it's print, web-based, social media, email, you name it. We can either improve and increase your brand and brand awareness in your local marketplace, or if you're looking to create custom ad campaigns to get in front of more prospects, they can work with you on that. And one of the things that I would mention to everybody on the call today, and I chatted about this a little bit last week, is we will put together a custom marketing plan for you. So if you're not quite sure what you want to do or what makes sense, I know COVID has really turned things upside down this year, but if you're not sure what direction you need to take, reach out and talk to one of your sales directors, and they'll go through and do a marketing analysis, go through a questionnaire with you, and then our creative team will go in, take a look at it, analyze it, and then we'll put together a customized marketing plan for you. So that way we actually have a plan in place that you can follow and implement to generate the types of ROI that you're looking for. Lastly, I wanted to touch on service, and I know all IMOs talk about good back office support and good service, but I really feel like this year has put a spotlight on that. You've had all of the carriers that have gone remote, and You're seeing bottlenecks with different insurance companies. And so service has really been a core aspect that's been an issue this year, I think, for a lot of advisors. And what I would tell you is service has been a cornerstone pillar of IMS for 34 years. And so regardless of what you need, wherever it's at in the sales process, whether it's some initial illustrations to making sure a carrier gets a case approved or getting it issued and pushed out the door in a timely manner, we're here to help you. And I would tell you we do it better than most in the industry. So if you have questions on that or want to look at some of the ways that we can help move the needle for you, again, certainly feel free to reach out and chat with your sales director over here. So as I mentioned, we've got Jon Salomon on the call with us today. He's going to be going through the second part of this life insurance series, discussing Index Universal Life. And again, Index Universal Life has really blown up over the last several years, and we're seeing it become a bigger and bigger part of the overall life insurance space. And I think now more than ever, when we look forward and we look at what we think the future tax rate environment is going to be, it's just going to grow that much more. And so, Jon, I appreciate you being on the call with us today and looking forward to what you're going to be going through.
Thank you, Curtis. Can you see the screen okay?
Yep.
I couldn't see yours when you were chatting, but that doesn't mean anything. Okay, you got that one? You see my name there? All right, well, thank you for that introduction, Curtis. Let's jump right into this. I just want to chat a little bit about what I'm going to go over, and then I'll obviously jump into it. I've been doing this for 32 years, and I've never been in such a crazy time in my career where there's just so many things happening. As I'm sitting here literally, listening to Curtis do the intro, got a text from one of the actuaries at one of the companies and wants to chat on Thursday. I got another call tomorrow with another company and their actuaries. And I got a call set up next week. We're just in a really interesting time right now in terms of Index Universal Life, where we are and where we're going. And, if you look at the slide here, one of the things that really came into fruition this year was, the 2017 CSO table came in, and so many products changed because they had to. I mean, the rules changed this year, and every single product we're selling is new. It's on a new chassis because they had to be. And what I really want to dive in today, and I don't want to bore you and say I'm going to go into AG49 because we all know what AG49 is and was, but there's some very significant things happening. When AG49 came in 3-4 years ago, it was designed to really, I guess I could say, levelize the playing field, reel in illustrations, make them a little more realistic with a higher likelihood of success. And I say that phrase, if you will, with intention, because I think we are all going to start hearing likelihood of success a lot more in the next few months, much like we've all heard about multipliers and bonuses in the last year or two because they're new. So let's just chat about what the intentions of AG49 were and what the consequences were, because I think that what happened was, we had these new rules and guidelines come in that said, hey, this is what we're going to do. And the actuaries may have sharpened their pencils a little bit too much and created a situation where the policies are probably a little more aggressive than they were before AG49 in many situations. And then I want to talk a little bit about what's next. And what's going to happen November 26th is the date that we are going to see significant changes to Index Universal Life. Every company right now, as I mentioned, all the calls I'm on is they're all scrambling to figure out if they what they need to do to conform to the new rules to make the illustrations look better. And it's my favorite line is, do you want the best product or the best illustration? Because they are nowhere near the same. And then with all these different changes, one of the most important things we have to understand in Index Life is the sequence of returns. And I'll get into that a little bit, how it works, and make sure that you guys really understand how to illustrate these things and how to build in some significant higher percentages when it comes to likelihood of success. So let me just start by saying this. I get calls all the time about, this product looks so awesome because of this detail. And I just want to say that there's not one moving part, one aspect of any policy that makes it better than the rest. You can say, let's talk about the cap. Let's talk about this company, this independent company that came out and did a big study, and out of 187 out of 210 cells of possible outcomes, this product's number one because of accumulation, because of loan distributions, because of this, that, and the other thing. It just doesn't matter. this product can have 18 triggers. It can have the 18 triggers for the chronic and critical illness riders. It can have the best long-term care rider. It can have all these uncapped strategies. You get where I'm going here, right? It doesn't matter what somebody says about a policy. There's not one thing that makes any policy better than all the rest. You have to look at all of them. And I could literally do 3, 4, 5 pages on this. But I think this just kind of shows the point that I want to just say you have to look at everything. You have to look at the entire policy because, again, there's not one moving part, one aspect of any policy that makes it better than the others. And let me just go back and talk about what really happened when we had the new guidelines come in and we had this new CSO table come in. And what happened was back in January, we had the new 2017 CSO table. Last week I talked about what happened when we switched from the 1980 to the 2001 table back in and making sure you understand the aspects of an internal review, if you will, an annual statement, and understanding how those costs went down significantly. And they went down this time, but if you think about it, they did not do us any favors when it came to protection-focused sales. In other words, if you had to sell a GUL, I said that backwards. On a protection-focused sale was a really good thing because costs went down. But if we were focusing more on the accumulation, trying to sell index life as an opportunity to make some money, because of the way the formulas worked out, it wasn't good news because the cost went down. You ended up buying more insurance for the same solve. In other words, you put $10,000 in and you had to buy $1 million. Well, now we have to buy over $1 million, and the decreased cost didn't make up for the increased purchase that you had to make. I hope that makes sense. I kind of messed that up a little bit. Sorry about that. But then when it comes to AG49, I want to just explain to you what really happened because I really think we ran into some big problems with the actuaries sharpening their pencils a little bit too much. And I'll show you what I mean by that. And I want you to kind of remember these numbers. Before we had AG49, we were illustrating, in the 8.43% range. And after AG49, because we all got reeled in, the illustrated rate up at the top of the page went down to 6.85. But what I want you to keep in mind is that if we had a loan at 6%, our distributions, the money we could pull out, the illustrated income, went from 70 to 85. So just keep this in mind that, we went from 8.43, now we're illustrating at 6.85. And we went from 70,000 to 85,000. Well, what does that tell you in your gut? To me, it kind of says, well, I guess the fees went down significantly. But if you look at it, the charges went from 70,000 to 202,000 on average. Now, there's some big outliers in there, some really big fee policies to throw this number off. But I'm going to go through and show you all of these numbers, the 84365, 685, the 70,000 to the 85,000, and the 72 to the 200. I'm going to show you where all those came from. But I just want to finish by saying this. The actuaries did get creative, and they have all these different opportunities and different features and different bonuses now that they can play with. And it all comes down to two little words, the illustrated rate versus the crediting rate. And I'll talk about that in a little bit. But I want to just take this into perspective a little bit further and say this. If we go back to universal life in the 90s, straight universal life pre-IUL, and we had a male 40, and he's going to put $10,000 into his policy for 20 years. So 20 years we're beyond the surrender period. And I just want to say that in a straight universal life, whoever had the highest cash value on this scenario, if they're both ran at 6%, should have the lower fees. Everything's equal. Just think of it that way. And what I want to say is, if you look at this next slide, and I say, look, here's company A and company B. On a regular universal life, I could come to a decent conclusion in my mind that the $727,000 cash value has smaller fees. But I'm here to tell you that is the old paradigm. It has nothing to do with reality anymore because of AG49 and all the creativity that was thrown into these by the actuaries and the fees. And I think I'll scare you when I get to the next couple of slides. But let me just take a step sideways here and say this. When it comes to comparing policies, I don't know. I love to ask this question. I said this last week on the call. I wish I could see your hands, but how many of you actually read a policy, you've read an agent's guide, and you've read an actual contract, right? And I love this line. And I learned this years and years and years ago at a conference in San Diego. If everything that you thought was true wasn't, when would you want to know? Think about that. If everything that you thought was true wasn't, when would you want to know? And that just makes sense to me when I think about comparing products, because we all want to do what's best, right? We want to put the client first. We want to put the carrier second in terms of doing it the way they want us to do it. And then we will all be taken care of if we do those two things, right? If we do what's best for the client, sell it the way the carriers want it to be presented, and then we will all be taken care of. And one of my pet peeves in this world is this, and this happens to me all the time, and I hope this doesn't come out the wrong way, but I'll get an advisor that understands index life, and they'll call me and say, hey, send me 2 illustrations, one with ABC and one with XYZ companies. In my mind, I'm always thinking, and I want to say it, and now I actually do, what are you going to do with them? Tell me how you're going to compare these. Because it wasn't long ago that an advisor could grab a specimen policy, they could grab an illustration, they could grab an agent's guide, read it, and really have a decent idea of the inner workings and hidden mechanisms inside these policies and come to some kind of a meaningful conclusion as to how they work. But I'm here to tell you, and hopefully by the time that I'm done in the next half an hour here, you're going to understand that by looking at 2 illustrations, 90% of us can't come to any meaningful conclusions without additional information that's not found in these traditional places, the guide, the policy, and the illustration. And it's because the algorithms that are built into how they pull cash out of the products, how they're applying multipliers, are they adhering to a 1% spread that AG49 called for? But I'm going to tell you that most of the policies do not adhere to that 1% spread because multipliers and guaranteed bonuses were not included. So there's a whole bunch of different moving parts here that I think we really need to understand. And it all goes back to why. Why did this happen? Well, the NAIC developed AG49 to really standardize and provide a level playing field for making it so that we could actually come to some kind of a conclusion to compare policies and really reel them all back in. And it was to the point where I would have new business people looking at illustrations. I'd say, look, go look at the year they start pulling out money. Just do me a quick calculation. If there's $1 million there and they're pulling out 140,000 for 30 years, in other words, it was more than 14%, send it to me, because I want to call those people and make sure they understand, because very few agents could really take a look at these things and understand that they have $1 million. I can pull 140,000 a year out, for 30 years, and that $1 million becomes $2 million. It's kind of crazy. There's a guy online right now that's talking about, Warren Buffett, be like him and use leverage and go out and let me show you how to use these policies. And he's really hyper funding these policies with an inferior product just because that one company is the only company that will let him do it. And there's just so many misinterpretations of reality out there, in my opinion, that don't make any sense. And, Mama always said, if it looks too good to be true, it probably is. And I want everyone to just get a better understanding of how these policies work, and more importantly, how they don't work. And why did all this happen? We had the idea of reeling in these crazy expectations on the illustrations, but it was really the whole life guys were starting to lose in the sales race. And for the first time, they weren't doing better than Universal Life. So they cried foul play and made a big stink. And we had AG49, and we all know what happened from there. But I'll end this slide by saying, I don't think we need to cook up these crazy illustrations to be successful. We don't need to show 13, 14, 15% distributions. And if you're set on those numbers, you're going to be shocked November 26th when you see what's going to happen to AG49-3. I think I covered everything on that slide. So let's just jump into what were the issues, what happened with AG49. And again, I know this is a review for many of you, so I'm not going to go super deep. I used to have 4 or 5 slides on each one of these things, but I just want to give you some of the high points, if you will, to discuss what the intention was and what happened and where we're going to go. Why am I doing this? Why am I talking about a rule that's 3 years old? Well, it's because I'm here to tell you it didn't work. AG49 was written in paragraph form. It was kind of short, and there was a little bit of insurance actuarial speak, if you will. And what they did was they came out and they created these illustrations that conformed to this loosely written guideline. And again, they got pretty creative. I don't think advisors can compare policies with these new rules in place. Like I said, I just don't think that these inner workings of these policies and the very, very hidden mechanisms have made it almost impossible to compare because of what happened. So I'll explain what that is. Let me show you. So none of us had heard of a multiplier before, right? Think of a multiplier as a participation rate that's above 100% that allows you to go beyond the cap. What does that mean? Well, you have the S&P 500 and you have 120% participation rate. You know, the market goes up 9, you have 120 participation rate, and you're subject to the cap. You know, 9 times 1.2 is going to get you above the cap, but you have the cap, so you're stuck. But if you have a 20% multiplier, it's the same thing, but it allows you to blow through the cap. And that's the big difference between a multiplier and a participation rate. It's how it affects the cap. Why had we never heard of these before AG49? Well, the actuaries got creative because they were not included. And there's more on the way. Lots of things happening with that. But it was considered a bonus, and it was created a wave of very expensive policies. And it showed people how to pay for these bonuses, if you will, these multipliers, with some pretty crazy fees. And I'm talking 4, 6, and 8% of cash value to get the upside potential. And I don't know how many of you saw a piece that went out 2 weeks ago. I gave some information to a guy named Rocky DeFrancesco and wrote up some stuff for this big lawsuit, particularly on this case. And that's something everyone's going to be hearing about real soon. This is a class action lawsuit against one of the policies out there that we've never sold for this exact reason. Let's talk a little bit more about the next thing, multipliers. They want to talk about the maximum loan arbitrage. I think we all know that this is a biggie. You know, you can't read in the policy anywhere what the clients or what the companies are doing to this maximum 1%, right? These illustrations show how the carrier does the calculation are just not in existence. In other words, we don't know if the carriers are using a 1% arbitrage until you really get into the fine print and understand the algorithms in the software. And obviously, if you see 12, 13, 14% distributions off the cash value retirement, you know we're well in excess of the 1%. And the reason this came to fruition, the reason we needed it was, you know, back in the day when we had these 14, 15, 16% caps on the S&P 500, and you could illustrate at 8.25%. And of course, the loan rates were down at 4.25%. You had a 4% arbitrage. And what does that 4% arbitrage do for you? Well, it shows you a 15% distribution. And I hear guys out there talking all the time about how this is very likely. It's the greatest thing ever. The 4% rule in financial planning is dead. I think that's a criminal maneuver. I think people, you know, if you don't understand it, that's one thing. But to go out and tout it as the high likelihood of success, it's just wrong. And again, when it comes to pulling the money out of these policies, there's a couple of things in there that most advisors and most marketers don't understand. Luckily, you guys work with IMs, and these guys are the best. They really get it. When you run loans, and again, it's really misunderstood. When you run a loan, would you rather pay 5% or 6%? It's obviously not a trick question, right? We all want to pay 5%. But if you're running an illustration at 7%, and you go into the policy, and you go into the software, and you change the loan from 5% to 6%, that's worse for the client. Doesn't make any sense. He's paying a higher interest rate, but the distributions actually increase. When you change that loan rate from 5 to 6 and you have a 7% illustrated rate, everything else is equal except the loan rate. You just raise it and it just magically increases the distributions. That's because of the AG49 rule, the 1%, that allows you to credit 7 on top of the 6 instead of crediting 6 on top of the 5. I hope that makes sense. So again, comparing everything on an equal basis just by raising the loan rate is not good for the client. In reality, when it comes to the actual, you know, policy doing its job, and you look at your annual statement, you will actually do better with the 5%, but the illustration is not conforming to reality because of AG49. Remember, all these rules only apply to the illustrations. They do not apply to the policy. That's very, very important. And then there's a lot of games that are being played on the illustrations nowadays. I've seen, you know, the annual versus monthly distributions go up to insane numbers. Traditionally, you should get a 3 to 4% bump. In other words, if you pull, you know, 120,000 a year annually, you should get a little over, you know, maybe 10,250 on a monthly basis, a little bit. But I've seen the way some of these algorithms are applied, and you're getting an extra 5 or 6%. So there's companies that look better on distributions just because they're playing games with the monthly versus the annual. And when you do that and you're reading this and you don't know to look for that one little point, there's just two really important things on this page that you need to understand. You know, was the loan rate set to maximize the distribution even though it's going to hurt the actual policy in reality? And are they showing monthly distributions because that particular company is playing some games? And that happens quite a bit. The other thing I want to talk about is the AG49 was the crediting rate versus the illustrated rate, right? The AG49, it's interpreted in so many different ways. But what it really comes down to is the crediting rate versus the illustrated rate, what they are, and I'd love to say what they are not. Now, maybe in oversimplification, but think of it this way. The illustrated rate is the number at the top of the page, and the crediting rate is the all-encumbering rate of return that the policy creates. And when you take a look at those two different things, how different they are, you'll be shocked. So let's just talk about two different policies. The first one has a 12% cap. The second one has a 10% cap with a 15% bonus. Now the 12% cap will get you 6.96 according to the rules associated with AG49. And if you have a 6.09 is what you get with a 10% cap. So you have a 10% cap at 6.09, but with a 115% multiplier, that gets you to 7%. So both of these, a 12% cap and a 10% cap with a 15% bonus, both take you to 7%. Now let's assume there's a 5% loan. What happens if you have a 5% loan? This is going to illustrate what I was talking about a minute ago. The 12% cap is going to get you to 6 over 5. Because the 12% cap has the 6.96, and they can only illustrate 6 over 5. Okay, so you only have a 1% arbitrage. But a 10% cap with that multiplier is going to get you the 6% times the 1.15. It's 6.9 minus 5. So you have a 1% arbitrage here and a significantly higher one here, almost 2% higher, right? Do you think your distributions are going to be better? Absolutely, they're going to be better. So that's why many, many companies will show you a 10% cap bucket within the illustration with a 15% bonus, because we can now arbitrage at 2 points, 6.9 over 5 versus 1.6 over 5. I hope that makes sense. And that's where the whole thing of increasing the loan rate actually makes it look better, because then you can show the 7 over 5. Outcomes are very different with everything that you look at. Literally, identical products can illustrate very differently depending on the actuary's interpretation of AG49, what they let you do with the illustrated rate versus the crediting rate. I hope that makes sense. The bottom line is this. The 12% cap in and of itself is more conservative. It's going to let you do a 6% rate of return, and then you can get your arbitrage over 5. If the market goes up 10, you get your 6 because of the cap. You're going to pay your loan rate. You made 1. Again, with the 10% cap, you have a 6.9 over 5. It's almost a 2%. It's double the arbitrage. Distributions are going to look much better. Can you understand that when you read an illustration? I hope so, because it's really important to understand that, specifically when I get into some of the next slides. Again, AG49 popularized and really let the actuaries run loose with multipliers and bonuses. And again, it's because they were not included. A multiplier is a bonus. But think about this. There's some companies out there, the number 4 company out there, they don't even price for it. They call it a return of expenses. What does that mean? Is it priced for? No, it's like a dividend with a whole life policy. They're calling it a return of expenses, and they're just throwing it in there, and it's actually not even priced into their actuarial tables for themselves to figure out if they can afford to pay for it in the long run. Now, a guaranteed bonus is a little different in my mind than a multiplier. And they're usually these things that say, hey, after the 10th year, we're going to add a quarter point. We're going to add 1 point. So if the market does 7, we're going to give you 8. Oh, if the market does 7, we're going to give you 7.25. But how are those bonuses applied to the 1% arbitrage rule? It's a big difference out there. If I have a 1% bonus guaranteed in the 10th year, and I start distributions 25 years down the road on a 40-year-old, and all of a sudden my 1% arbitrage set by AG49 is now 2% because of this guaranteed bonus. And the most important thing is, are they legit? Yes. Do they work? Yes. As long as the company's guaranteeing it and they're setting aside money to do it, which actually limits the upside potential. My favorite thing about index life is that, guarantees are expensive and risk is free. And to me, I'd rather not pay the money to get that 1% bonus. I'd rather take the cost of that 1% bonus and put it towards higher caps, because in the long run, it's going to work out better for you. That's all I'll say about that. I don't want to get too deep into that part. Again, let's talk about the maximum illustrated rates. And AG49 had these rules set in place. And this is the last thing I'll go through with the rules in AG49, what happened. But based on the 1 year point to point, and the S&P 500 with thousands and thousands of data points. The carriers would say, hey, if you have this cap, we're going to go back 40 years, fast forward 25 years from that 40-year period multiple times, and we have a rate. That's where I came up with the 12% cap, at a 6.09. Those are given. And they're designed to standardize the illustration rate wars, because it really was the wild, wild west out there. People were just going nuts with these things. Because think about what happened to these carriers before AG49. How did they set their illustrated rate? They would sit around and go, all right, well, we have a 12% cap. If we do a 15-year look back with a 12% cap on the S&P 500, we can come up with a 7.65% rate of return. Oh, but if we go back 20 years, we can get 7.95. So they go back 20 years. There was no standardized reasoning to why these policies worked the way they did. And carriers just artificially change things based upon what made their policies look better. Now, in these new rules, can a company artificially pump up the cap for a better illustrated rate? Yes, but that's just not going to work out for them in the long run, right? We want to make sure these companies are putting realistic numbers in front of us. And 60% of the industry puts premium into the S&P 500. But what if you're working with a product where only 5% of the time they use the S&P 500, right? And again, the whole idea of AG49 was based upon using the S&P 500 to come up with these illustrated rates. So there's lots of companies out there that do things outside of the S&P 500. What if their focus is on asset allocation models and diversification within this and not using the S&P 500? What if the focus on non-traditional hedging? One of the things I love to talk about is the volatility controlled indices and how these work. And specifically in these markets we've been in, they've been working really well. Those types of carriers are at disadvantages, so they might need to artificially prop up the S&P 500 if they're not focused on that, just to make their illustrations look better, and that's not fair. So we did need some changes in there. So just to summarize this, AG49 came in place to reel in illustrations. It was designed to levelize the playing field, but the actuaries may have got a little too creative. Some absolutely 100% went over the edge. Because they wanted to fund the bonuses, they want to fund these multipliers and make things work. And now, what I want to do is show you what really is happening. And this is part of the reason why Rocky's email went out last week. And this should scare you a little bit. Now, if you take a look at where we were on illustrated rates, these are the numbers I showed you: the 843 and the 685, the 843, the 685, the 69,000, the 84,000. The 72,000, the 202. Those numbers came from these carriers, okay? And what this shows you is what these carriers did pre-AG49, this one illustrating at 8.5. Post-AG49, they're illustrating at 6.86. Pre-AG49, their income was 66,000. They went up to 76,000, and their fees went from 66 to 79. But look at this particular company. Pre-AG49, they were illustrating at 10. Now they're illustrating at 5.76. Their income went from 70,000 to 93,000, but their fees went from 78,000 to literally 600,000, more than the premium. This is based on 20 years of 25,000 on a 40-year-old. That's 500,000 in premium. This one down here is actually in competition with the day after AG49 came out. One of my clients called me, one of my biggest producers. It's an agency. Hey, we just had the rep come in from company I, and they were talking about what their new policy. I can't believe how much better than the company that we've been using is. And I just said, do you understand what they did? Do you understand the fees? And the rep that came in didn't even talk about it. And again, I don't want to try to be sneaky here and tell you A, B, C, D, E, F, G, H, and I, but think about what Curtis and Imes and what we're doing here, right? We're trying to earn your business. And if you're getting all this kind of information from your current FMO, that's awesome. But what I just hope that you guys give us the opportunity to show you how index life works and doesn't work, because there's too many policies out there that created the best illustration and not the best product. And that to me is a huge problem, specifically when we look at this one. This $603,000 product, I've literally talked to 20, 25 advisors in the last 3 weeks. And every time I say, hey, go to page 11. Look, you tell me you ran this thing, you dialed it back to 5.25. And let me show you year 11. And year 11, you had $1 million in there. Here's your $50,000 crediting rate. And then right next to it, there's a bonus of another 10,000. Next to that is another bonus of 60,000. So you're well north of 13%. and they didn't even understand how high the fees were on these policies. And I just want everyone to understand that, illustrations, you have to know where to look and understand the fees inside these policies. That's what this whole thing did with AG49, was it created this mess of very, very expensive policies that just look really good on an illustration. And again, if you take a look at what really happened, going from 8.43% down to 6.85% on average between these companies, and the distributions went from 70,000, to 85,000, and then the charges went from 72,000 up to 202,000. That's a big deal. And again, I'm not trying to be sneaky. I'm not putting the names of the carriers here. If I give you all this information, then you just go back to where you're currently doing business and say, hey, I understand that the E was a really good policy, and taking a look at I and taking a look at C, I need to know what these are. We're not doing that. We want to just get the opportunity to have a conversation with you. Otherwise, every time I do webinars and I do training, people take the information, just go where they work, so they have that relationship. And I'm just trying to get the opportunity. I hope you guys can appreciate that. So the next thing I want to talk about is literally getting into the sequence of returns. And why is that so important? Because it's all about avoiding zeros. If we have lower illustrated rates currently, we have much higher fees. Where's the risk, right? The risk is really shifted from the company to the individual prospect, right? When they're buying these policies, if the market does 7 every year and never has a zero, we want the biggest charges and the best upside potential. But that's not reality. Zeros destroy these high fee policies. A couple of zeros will destroy it. And I want to just, this is a little bit of a stretch, but hopefully you can follow this. You run a quote. You put $10,000 a year on a 45-year-old for 20 years. At age 65, you show a distribution 72,250. What if you manually go into the software and you take that 72,250 and you don't change anything, but you just tell it to pull out 72,251? That $1, what does that do? I'm here to tell you, it blows up the illustration. So having all that, that opportunity for success, and having all that money come out, that 72,250, think about that. The algorithms on the software take you right to the edge, so that $1 more blows it up. What happens if we start pulling less out? It builds up a nice security blanket. I'll get into that in a minute. But I want to go through this because returns absolutely matter, right? A diversified allocation on a policy can increase returns in the long run while minimizing the zeros. And think about what I'm saying here. You look at this, and you have a S&P 500 versus a diversified policy. If all the money's in the S&P 500 and we have a 12 to 14% cap, we're going to nail that 42% of the time, right? So we're going to do really well. We're going to do 42% of the time. We're going to do 12s and 14s. But the flip side of that, here you have Hank Aaron or someone just banging a bunch of home runs. In the last couple of years, you've heard a lot about who's a good one? Joey Votto. Joey Votto. That guy has not been striking out. And so look what happens though. We have guys that are striking out a ton. We want to be Joey Votto down here. So if you're going to hit a lot of home runs, you're also going to strike out. And when you do that and use the S&P, you come up with a 7.48 over a long run if you have these types of caps, okay? What I'm trying to say is this. Let's try to hit a bunch of singles and doubles and triples and get a better average. If we diversify, we're not going to bang the 12s and 14s as much, only 15% of the time. But instead of striking out, one out of every 4 or 5 times, we're only going to strike out 3.68% of the time. And what does that do for us? Well, we're not striking out. We minimize zeros. We hit for better average, and that's where the 7.67 over the 7.48 comes in. And what I'm trying to say is it's better to diversify because diversification minimizes zeros, will minimize the highs and lows, if you will, and just work out better in the long run because we really need to avoid zeros. And what do I mean by avoiding zeros? Think of this. You got a male 45, he's going to pay $25K for 10 years, doing it right way, increasing death benefit, then going level, taking loans out at age 65. And I'm going to show you what happens when we have the rates at 5.5%, 6%, and 6.5%. Okay, I'm going to run those numbers and show you what the distributions would be on this using the rates at 5.5%, 6%, and 6.5%. And then I'm going to go through and show you what happens if we still get 5.5%, 6%, and 6.5%, but we have zeros every 5 years. And I think you'll be shocked by this. And this thing really shocked me when I first saw it. So if we have the opportunity to go out and borrow out of this policy, and we're getting a 5% rate, we can pull $37,000 a year out on this guy all the way to age 120. If we get 6%, excuse me, let me say this again. So you pull out $37,000, but if we get a zero every 5 years, still getting the 5.5%, that 120 drops all the way down to age 90. Okay, on the 6%, we can go from 37 to 48,000, and if we get a zero every 5 years, or get the zeros in, the 48,000 only comes out until age 82. Now, if we go to 6.5%, the 48,000 goes up to 54,000. But now, if we have a zero every 5 years, we can only pull it out till age 79. And what I really like about this is I want to just show you how to make that 90 get back up to a 120, get the 82 back up to the 120, get the 79 back up to the 120. And think about what I said a minute ago. In this illustration, the software and the algorithms are telling me I can pull out 37,307. But if I go into the illustration and I go to the page that says, hey, calculate the distribution for me, and I just change that to manually put in 37,308, it's going to blow up. And getting a zero every 5 years, still getting 5.5%. It's only going to ask to age 90. But if I go in there and I manually drop this 37,000 down to 36,000, it goes all the way to 120. And let me ask you this: if you showed a client 37,307, or you showed them 36,000, are they still going to buy it? I'm going to say the answer is yes. If you take that 48,514 and you change that to 46,000, it goes all the way to 120. That's the power of this software and the algorithms built in. Again, if you pulled out 48,515, it would blow up. But by dropping it down a few thousand, literally less than 5%, you can go into the software and have a zero every 5 years, still averaging your 6%, and the policy will go all the way out. And that's just the inverse of adding a dollar, is just subtracting a little bit. The security blanket that you build into these softwares programs by just bringing these down a little bit is significant. And again, I just think about that logically, that if you have the software and it's telling you can pull this out, and you just go up by $1, it blows up. That just tells you how far it stretches and how it takes you right to the edge. Let's back off the cliff a little bit, show something that's much more likely to happen. You have a much higher likelihood of success, and it's not a big deal. We're just dropping these by a little tiny bit. And what does all this really mean? I went through a lot right there, and what it really comes down is you got to work with someone that gets it, right? Are you sure that the guys that you're working with understand the inner workings and hidden mechanisms in these policies? Can they explain how the product is illustrated? Do they understand the algorithms? Do you do all your business with one IMO? And I want to talk about this because when you send someone an opportunity and you're in competition, you might be in competition with a product that's really illustrating these crazy numbers and high expenses. Everything has to be on the table for IMs to support you, right? They can't just come in and say, I'm competing with one of those super expensive policies, and you're looking at two illustrations, and one's got a $70,000 distribution, one's got an $85,000 distribution. Obviously, you're going to put the $85,000 distribution in front of your client, but you may not know what all the fees and everything are on the downside. And again, the likelihood of success on that will be significantly lower. So the idea is to have a really good relationship. Let your guys and girls know what you're dealing with, right? Especially if you're going to a couple of different places and sourcing out, giving someone an opportunity. They have to know, because put yourself in the marketer's shoes. If you send them the opportunity and you're sending someone else the opportunity, someone may cook a policy, someone may not. The system's flawed because we have to understand what the competition is and see where you are. Do you really want to have the best policy, or do you really want to have the best illustration? And I said this last week too, and I say this all the time. You're with a company that doesn't want you running your own quotes. They want to give you the best service in the industry, right? That's what IMS does. But I think you need to be able to do it so that you can show some changes when you're on an appointment with someone, right? And also, the best way to really understand the flexibility and all the moving parts of these is to really play with the software yourself and make sure you do it. So I always say, the best way to learn how these products work is to read the illustration, read the agent's guide, and actually read the policy and run quotes, play with them. So a couple of takeaways from today. Things that you need to remember, right? The sequence of returns, that's a big deal. The impact on distributions, adding that $1, subtracting 5%. It's a huge difference with the policies that have much higher fees in them. And think about the diversification model too, right? Where do we go here? the diversification, right? We just don't want to use the S&P 500. We don't want to strike out a lot. We don't want to hit a lot of home runs. We want to hit a lot of doubles and triples and have a better rate of return. And think about this. I said this earlier. Index life is awesome, right? It does a lot of things for us. It can accumulate tax-deferred, tax-free, give you phenomenal distributions, and it can protect you with long-term care in some situations, but more importantly, the chronic and critical illness riders. It can and will not do all three. We talked about this 2017 table, what happened with that, and again, I did mention what's going to happen November 26th. But a lot of this comes down to when these companies come out with new product and what happens with the interstate compact. And this is kind of a little bit of a jump here because I didn't mention this. I took this slide out. But when companies register in all the states, they can go knock out roughly 40 states with one opportunity. It's called the interstate compact. And when it comes to that, it really levelizes things because the interstate compact says, hey, I'm going to let you register in all these states, but your long-term care, your chronic and critical illness riders are all identical. So there's a lot of different moving parts when it comes to understanding how those things work. And Curtis, we should probably do a webinar specifically on those because I do believe that they're the most oversold part of index life. I can't tell you how many times I've met someone that said, yeah, I bought that because I got long-term care, and they're with a company that doesn't have long-term care. It's a chronic and critical illness rider. I'm in California, so our policies specifically say, if someone reads a policy, it will say in there, hey, these chronic and critical illness riders are not meant to be a standalone product. The need for life insurance has to be there because these things, they're basically not worth what they're sold at many times. And I do like to mention these things when I talk about things. Remember the significance of sweet dates and understanding dollar cost average, and more importantly, understanding what happens if someone has a policy. If one of you guys is about to do a policy, you're doing a 1035, and let's just say it has an October 15th anniversary day, and you go get rid of it today, they're not going to get their money on October 15th. If the market's way up, you just got to keep in mind when you're doing a 1035 on policies, index life, or even whole life policies. If you're going to take a whole life policy off the books right now that's got an anniversary date October 15th, we should probably wait till October 16th so they get their dividend. I talked about the annual versus the monthly distributions, understanding how there's games being played there and how you need to understand the differences specifically when you're trying to compare. And hopefully you guys get what I was trying to say at the beginning when I was talking about, it's really difficult for you that don't understand all the moving parts inside these illustrations to compare the two. I'm not trying to scare you and say, yeah, index life is complicated. No, you just have to understand how they work. It's not that difficult, but I just don't like it when the advisors will call me and say they're going to compare these two companies. I want to know what they're going to do besides just look at distributions. You have to understand all the parts, and specifically the bonuses and how they're locked onto the distributions and if they're adhering to the 1% rule. And Curtis, I think that with that, I'll turn it back over to you. And we'll do the next slides. I'm going to cover on another opportunity just because I'm going to do this one last slide. I wanted to say these things because I always put the old mutual story up before F and G. You have to understand how these products work and specifically the underwriting, all the moving parts of the companies. And I'd love to tell the old mutual story because back in the day, 20 years ago, they had the cheapest term, the highest comp, and the best underwriting. And look what that did for them, right? There's so many things you have to understand about these policies. Loan rates are very important, obviously. But think of this. When you're talking about the current rate, if you're doing illustration at 7%, and we're illustrating it over 6%, and the Moody's corporate bond yield, if you look at the 30-year average on that, it's closer to 7 than it is to 4. So that actually, in the long run, if interest rates do go back up, it does hinder the ability to come to any historical conclusions because we're all using current S&P numbers and comparing it to, and not comparing it to historical Moody's rates. And another thing that's really important is understanding if companies are crediting their numbers at the beginning of the year or end of the year numbers. I did mention the 1035 stuff there. That's really important. Show conservative illustrations. We don't need to cook these things to make them realistic. And one last plug I'll throw out there is think of it this way. My favorite companies, the index companies that I choose to work with, aren't life insurance companies. They're annuity companies, and there's a reason for it. They're doing their own hedging, many of them. They're the ones that have the whole gamut of opportunity in front of them to do it as efficiently as possible. I love to go to meetings where I'm with all the annuity shops in the country. I'm the redheaded stepchild there because I'm the life guy. but I'm there intentionally because I believe that companies that sell a lot of annuities have a much higher likelihood of success of meeting our customers' expectations in the long run. And I did cover a little bit about the zeros. We need to avoid them and how to do that. All right, Curtis, I think I'll stop right there.
Well, I appreciate you being on the call with us today, John. That was a lot of good information, and I hope what everybody's seeing is the same thing that I do. And John, I mentioned something a couple of times throughout the course of the presentation, but do you want the best product or the best illustration? And as you've probably seen, there's a lot of nuances with how these things can be modified and adjusted. And so I'd encourage you to reach out to your sales directors over here. We're more than happy to chat with you about index universal life insurance, how to position it, and really how to evaluate if somebody's got a plan. I had actually a contractor going through today, and clients 6 years into the policies, they've plugged, I want to say about 45,000 into the contract, but their accumulation value is only 19,000. Well, then you go in there and you take a look at it and you see the amount of fees that are in there, and it's, well, what's the deal? So it's not just all about illustrated rate. Two other points I wanted to make to everybody is, first off, September is Life Insurance Awareness Month. So if you have not got our Life Insurance Awareness Month sales kit, reach out to your sales director and they'll get that over to you. But we've got about 30 different pieces in there to advertise life insurance across social media, email, print, as well as a number of point of sale pieces and sales concept pieces that you can utilize. Also want to mention to you as well, we have rolled out Stonewood Financial Software, which is a great tool when we talk about tax rates and what we think the future tax rate environment will be. It does a very effective job of going through any scenario that we want to illustrate, whether it's an increasing, flat, if we theoretically wanted to illustrate a decreasing tax rate environment, and matches that up with the IUL illustration that we do. So if you've got questions on that, feel free to reach out to us. We are going to be doing a webinar on that here in the next couple of weeks that all of you will see some emails on. But we appreciate everybody being on the call today. John, I appreciate
you. Hey, Curtis,
you as always.
What if they don't have a sales director? Who do they reach out to?
Everybody should have one, or you can reach out to me. So give Jess, Tony, Chance, myself, Curtis a call. We're happy to help everybody. So appreciate everybody being on the call today, and have a good rest of the week.